Hi, Steve here with IBC Global. What I'm going to talk about today is the subject of setting up a whole life insurance policy for as much cash value as possible. But we'll focus on two different ways you can design a policy. We'll look at a 40-60 design, then also a 1090 design. And the purpose of this video is really to analyze a design that we had recently seen. It was actually in a presentation that claimed that there was proof around the fact that a 40-60 policy will produce more cash value than a 1090 policy. My natural question is, really? Like, is it a fair comparison where it's apples to apples and the 40-60 actually produces more money for the consumer? Because the insurance company and agent make a lot more profit with this, just when you look at how insurance works. So, before we just dive into the comparison, I'll briefly explain what a 40-60 and a 1090 is and what it means. So it has to do with getting a whole life insurance policy where you are interested in the cash value. So with any whole life insurance policy, you have the cash value and you have the death benefit. When you pay money into the policy, instead of me, an agent, telling you, here's how much it costs, you can throw that approach out the window and say, here's how much I want to pay into this policy. And when I paid into the policy, Steve, cash value is what I'm interested in. Maximize it for me from start to finish. I say, okay, here's what you want to be aware of. If you're paying $10,000 per year, you can decide where that money goes. It can go toward what is called your base premium or your PUA rider. We'll explain both. The base premium, money you pay here, typically will not show up in cash value in the first year, sometimes the first and second year. Depends on the type of product, but with a traditional whole life insurance policy, which is the most commonly type of whole life insurance product that's sold, I usually don't see any in the first year. The reason why is because that premium buys you a big death benefit. So if I paid 10 grand into the premium, I have zero in cash value, but I might have $1 million death benefit. The other area, PUA, stands for Paid Up Additions Rider. I like to call it a cash dump-in because money I pay here shows up in cash value immediately. It's typically 90 to 95% immediately. I won't see 100% of it, but it shows up in cash value, begins compounding, I can access it. It's the key to accelerating the cash value growth of a policy. It does get me some death benefit, but it's very small, especially when compared to what the premium gets me in life insurance. With these two areas, if you're interested in a policy and cash value is your goal, where would you want to put money? In the premium, knowing that it gives you nothing in cash value out of the gates, or into the PUA rider? PUA rider, that's what I would want. We even get the question sometimes, can I just put nothing into the premium and everything into the PUA piece because I only care about the cash value? The answer is no, we can't go quite that low. But then the follow-up question I would ask in that situation is, well, how low can I go in the premium? That's where this 1090 and 40-60 come into play. So what a 1090 is, what it means, is that of my $10,000, I'm only putting 10% toward the premium, which would be $1,000. Now, the money that doesn't show up in cash value is minimized. I don't want my full 10K taking the hit. What's the least amount that takes the hit? $1,000. And then the other 90% goes toward PUAs. So that is an example of a 1090. I'm beefing up the upfront cash value. Now a 40-60 design is what you would think it would be. I'm putting 40% of my payment of my 10 grand into the premium. So it's $4,000, which means now of the 10K I'm paying, 4,000 is not showing up in cash value. So I have less upfront. Why would I do that? And how on earth Could that produce more cash value for me long term? We're going to look at that. So I hope that made sense. Let's get into the comparison here. So this comparison is based on what someone had recently presented. It is with a smaller company, so not one of your 4 major mutual life insurance companies, but an A-rated company. Here's what we've got: a 49-year-old male. We see the smaller life insurance company, and the funding is $25,000 per year. That's what they are illustrating for a potential client. Okay. The designs we're going to look at: a 10/90 split. Here's the exact breakdown. Base premium, 10% of the full $25,000. So $2,500, 10%. We've got a small term insurance rider that is necessary as it prevents what is called a modified endowment contract, or a MEC, which is a taxable event. If our policy becomes a MEC, we've got to deal with taxes. No one wants that. The cash value is tax-free if we do everything right, so we want that term rider. It's necessary. And then the rest goes into the PUA rider. Total out of pocket, $25K per year. Then we've got a 40/60 design. 40% of $25,000 is $10,000. We still needed a small term rider. I should say that is what was presented. And then the rest goes into PUAs. And here's what was designed. So again, this is not what we had put together. This was a design that was showed in order to claim that proof exists that a 40/60 policy produces more cash value than a 10/90 design. A 10-year level term rider was used. After funding the policy for 10 years, the term rider fell off, and then what was illustrated was the PUA rider dropping all the way to 0. And the reason why is because this prevented a modified endowment contract, a MEC, which again is a taxable event. So it resulted in the following. The 10/90 policy had $25,000 per year going in for 10 years while the 10-year term rider was attached. After the term fell off, only the base premium was paid, $2,500 per year. Whereas with the 40/60 design, first 10 years, $25K per year, years 11 through 30, $10,000 per year. Okay, let's illustrate this. First, we'll look at the actual illustration, and then we'll look at a side-by-side on Excel. That typically helps me just go through everything. So, first we've got the illustration. 49-year-old male, standard non-tobacco. This is the 10/90 policy. The funding, $25,000 per year for 10 years. And then after that, we've got $2,500 per year. We can see that the term rider drops off here when we look at the net death benefit. Look at it go up, go up, go up, go up. And then after the 10th year, it drops. That's because term insurance was dropped. Now, how do you know that this is actually a 10/90? Because I said it was. I typed it out in the Word document. But how do you actually know? Well, all life insurance illustrations do disclose where your money is going in terms of premium and different riders. We have to look at different sections depending on the company and product. But here we go. Down here, see coverage, base policy insurance represents the base premium, $2,500. Then you've got term rider, $741, and then the rest goes toward PUAs for a total of $25,000 per year. So this is our 10/90 design. And again, the thing that I want to emphasize here is after the 10th year, the term rider fell off, and that's why the funding dropped to $2,500 per year. This is not what I would do if I'm designing a policy, but this is the argument. This is what was used to support the argument. Let's look at the 40/60. $25K per year for 10 years, and then $10,000 per year thereafter. Okay. Look at this with the death benefit. Drops again after the 10th year because the term rider falls off. How we can tell that this is a 40/60, if we go down to the same breakdown, there's your base premium, 10 grand, 10 of 25,000 is 40%. We needed a small term rider in this example, 300 bucks a year, and then the rest goes into PUAs. Okay. Let's look at this side by side to see which one gives more value. That way we don't have to scroll back and forth when we look at the cash value. First, we've got the 1090. Here's what was proposed again in a presentation by an agent. So first you see the breakdown, 2,500 per year, term rider, PUA, net out of pocket. Total funding, and then cash value. What's highlighted in yellow helps us see the break-even point just about year 5. Your upfront cash value is very rich as well. But then we've got the 40/60, 10K per year. Term rider cost, much lower. There's your paid up additions rider. Where's the difference here? First 10 years, you're paying in the same dollar amount. Then what happens? You're able to pay more money into the product with the 40/60 policy because you have a higher premium. The premium is contractually fixed. That's why it doesn't go down. There are some moves you can make to reduce it, but it's difficult and usually it doesn't make sense. It changes the MEC limit and such too. Anyway, we're paying more in. So when we look at this, what do you notice? Well, initially, we've got less in cash value. Why? The premium takes the biggest bite out of cash value in the first year. Takes longer to get your money back. 8 years to get your money back. I wouldn't do this. I personally would not. Just when I look at the numbers, it doesn't make sense. There's so many other things I could do with my money in the meantime instead of waiting 8 years just to break even. Like that's just too far behind for me personally. But as we look at this, which one has more cash value? Well, long term, if we look at year 30, the 40/60 has $177,000 more. Should I just stop there? No. I think that's complete horse manure to try and argue the fact that I've got 177 grand more. And the reason why is because we pumped more money in. We've got 10 grand per year going in, literally 4 times the dollar amount than what we've got going in with the 1090. So what we would really need to do here is look at the difference, which is about 150 grand, and subtract that from the cash value difference. And then it's less than $30,000 in the net difference. But that's not fair either because we've got to really look at the same dollar amount going in. So here's the argument that is frequently used to support going with the higher base premium, or a 40/60 design in this case. 1, you can pay more money into the policy for a longer period of time. What you can pay in terms of more money is the higher base premium that you set up front. So by taking less up front, you have a permission slip to add more money for a longer period of time. I fully disagree with this when you know how to design a policy. Number 2, if you pay more into the 1090 policy, it will MEC. Okay, is that true? Like if we go with that same 1090 policy and add more to it, will it become a MEC? Let's take a look. So here's the same illustration as the 1090. This is the 1090 design. So first we've got this guy, the 2,500 per year going in. This illustration is identical. So same death benefit up front, same cash value for the first 10 years, same break even between years 5 and 6. The difference is what? We've got 10K per year going in instead of 2,500 per year. How do you know if this is a MEC? If you're a seasoned veteran in the business, you see this and immediately know. But what if you're not a seasoned veteran? What if you're a consumer and you look at this and say, this thing looks like stereo instructions. I don't want to have to understand this. Just tell me if it's an issue. Here's what you can do. I would search the term MEC. And here you go. The policy, as illustrated, will become a modified endowment contract, MEC, in year 12. If we go back and look at the other two illustrations, they were non-MECs. So, this is what the agent had shown just with $2,500 per year going in. But now, if we're funding $10K per year, what happens? It becomes a MEC. Let's take a look at it on Excel. So here's that same policy that was proposed by the agent. You got the $2,500 per year, or $2,500 base premium, 10-year term rider, $25K total, and then he drops the PUA. Okay, looks good. Here's the same policy, but we're going to pump more money into it. 10K in year 11 instead of 25 or 2,600 bucks. Doesn't become a MEC. Term rider fell off. We can see the death benefit drop. 12th year, we pay in 10K again, but that's the year it became a modified endowment contract. And what that means is if you access the cash value with respect to the gains only, you'll have to pay ordinary income tax and a 10% penalty tax, but the death benefit is still paid income tax free. Doesn't matter if it's a MEC or not. So the numbers will look better long term, but if I want to access this, it kind of defeats the purpose. Okay, so let's go back. Based on what you just saw, does that mean if you look at a 1090 and a 4060 and you want to pay $25K per year for more than 10 years, do you have to go with a higher base premium? Is that the only solution? Let's put it that way. Meaning the only way I can put more money in is if I commit myself to a higher premium, I take less money up front, I give it up to the insurance company in the base premium, and then the agent also makes more money. Like, is that the only way I have a permission slip to truly pay more money into this policy? The answer is no. Let's look at not just one solution, but multiple solutions I would progress through with someone here. So the first thing I would do on my own is just run the numbers and review the MEC limit. I'd MEC test it. That's the first thing I would do. But then the second thing, I would look at the same company and product that the individual was proposed. So we're going to stay with the 10-year term rider, but just increase the amount of term insurance that's attached. It's only going to increase by a couple $100 in this example. But what this does is increases the MEC limit. Want to see it? Yeah, let's take a look. You can tell I like this stuff too much, right? I know I'm weird. So here we go. We've got the same 49-year-old individual. This is a 1090 design. So how can we tell? We'll go down a couple pages. There's our base policy. $2,500 base premium. Term rider, instead of $325, is $500,000. So we've got a bigger term rider attached. Costs more than $740. So that's the cost for 10 years. But I tell you what, $300 more in a term insurance premium is a whole lot better than a base premium that's 4 times the original size. Like, come on, that's what's eating up your cash value. And then the rest goes into PUAs. Okay. Next thing. Does this MEC? That's what I want to look at here. The policy, as illustrated, is not a modified endowment contract. Sweet! Shall we look at a comparison? Yes. Let's take a look. So here's the MEC example we just looked at. There's the initial death benefit. This is our 1090 policy. But then here's the illustration we just looked at. I'm going to walk through just the important items. What's the big difference right here? The term insurance rider. What does that do for you? Gives you a higher initial death benefit. What does that have to do with anything? The death benefit has a direct relationship to the MEC limit with a life insurance policy. So a detail that the policyholder does not always need to know, but if you like the details and such, It's good to understand the reason why we've got a little bit more term insurance, a little bit more death benefit. It prevents a taxable event and lets you have a low premium and just plow money into the policy for a longer period of time. Break even, still between years 5 and 6. When we look at this guy, the term rider falls off in year 11 in this example. That's why the death benefit drops. But then we keep paying money into it. Look at that. $2,500 base premium, $7,500 PUA, $10K per year. At age 75, with this company and product, we can no longer illustrate money going into PUAs. That's why it dropped off in this particular example, and now we're paying just the premium. I would stop it at 75 because I think it's cleaner, but that's a illustration limitation that we ran into here, a company and product illustration. Point is what? There's a solution. All we did was make the term a little bit bigger. It's nice to be aware of. Like, I'd want to be made aware of that. If I'm interested in a whole life insurance policy, I want as much cash value as possible, upfront and long term. I don't want to be told, hey, you have to go with a $10,000 base premium and take a big hit on your upfront cash value if you want to pay more money in for longer. It's like, no, you don't. All you need to be aware of is the fact that we can add a little bit more term. That's one solution. Let's look at another. We can add a 30-year term. So if you said, hey, the idea of paying $25K for 10 years and then dropping to $10K, like, that's not what I want to do. I want to keep adding $25K per year. Can I do that? The answer is yes. Yes, you can. All right. Let's take a look. First, we'll look at the illustrations. Here we go. So here's our 1090. We've got $25K per year going in. First year cash value, just about $21K. How can we tell it's a 1090? Down here, base policy insurance, base premium, still 10%. 30-year term rider, going for a longer period of time, $1,700. Okay, did it MEC? Got to find out. The illustrations always tell you. Not a modified endowment contract. Okay, perfect. So it did not MEC. Let's look at our 40/60. 25 going in. First year cash value, just about $16K. Base premium, $10,000. Smaller term rider. I do need less term if I go with a higher base premium. And $25K per year. Did it MEC? No, it did not. Okay. Let's look at the two side by side. This is going to be the apples to apples comparison, or I should say, one apples to apples comparison. Here we go. $25K per year, up until age 75 or through age 75, and then nothing thereafter. Break even for a 1090 between years 6 and 7. This has to do with two things. One is his health rating. Two is the product. We're using this product solely because this is just keeping everything consistent with what was originally presented. I would use a different product in this particular case too in order to enhance the values short-term and long-term, actually, just when we looked at the numbers. But using the same product we have been since the beginning of this case study, breaking even between years 6 and 7. Then we've got the 40/60 with a 30-year term, $25K per year. What do you notice? Break evens between 9 and 10. What about the difference here? This is apples to apples, by the way. Cash value difference. This is showing us how much more or less we have with the 40/60 compared to the 1090 split. We've got less from start to finish. Do we ever see more money with that 40/60? No, we do not. And we've pumped the same dollar amount in with the exact same company and product. What about death benefit? I see a little bit more for the first 3 years. How about long term? No, I do not. Now, an argument we sometimes hear here in this case is, well, if dividend rates go up, this could produce more money. Yeah, it could, but we've never seen that happen. We've seen too many cases where dividend rates go up and the policy dividend and cash value performance does not follow it with the dividend rate. So there's been too many cases where I've seen that not happen to confidently recommend to someone go with the higher base premium because interest rates and dividends should go up. It's like, no, people's money that we're dealing with here. I'm not doing that unless I see proof. Anyway, that's a solution. And then my favorite solution here, look at multiple companies and products. And really, this is where the education piece comes in, or building awareness around what's available. This is like my favorite thing to do. So let's look at a couple different options here. And we'll look at first, $25K per year through age 75. So this product, we couldn't get the base premium quite to 10%, but I looked at it and said, this is close enough. 2,500 would be 10%. We're very close. Got $25K per year going in. This policy does not MEC. There's your MEC limit. You can go up to the MEC disclosure to see if it MECs. It did not. Important tax information. Not a MEC. Not a MEC. And if you really want to dig into detail with this, what you could do is run the MEC test based on the guaranteed values, a conservative dividend, the current dividend rate. Like, there's a lot of extra steps you can take to make sure we don't run a risk of a MEC occurring in the future, which the big risk is if dividend rates go down. Like, that's where we've just got to take a couple extra steps in MEC testing the policy. Anyway, that's one illustration. We've got another one here, which is the same thing, but I'm just going to show you this one on Excel because it's more fun. All right, so here's what we got. Next tab. Ready? This is the Mass Mutual policy we just looked at. $25K per year through age 75. Break even year 5. Cash value close to right around 90% in the first year. Here's the other illustration. What if I want to go longer? Same product, same setup, didn't do anything differently. I can decide this after I start. Funding, in this example, through 75, but now you say, can I keep on adding money to this policy? Yeah. Now we're going to add it till I'm 85 in this particular example. And then after that, I'll stop. Just let it ride. But this shows a minimum premium policy where I feed it for a long period of time and does it MEC? No. So here's the example where I feed it until I'm 85. I go up to the MEC disclosure. Not a MEC, not a MEC. Okay, good. Last illustration I want to look at. Different company, if someone's interested in funding for a short period of time. There's the base premium. There's the cost of the term rider. And we're plowing everything else into PUAs. So here we've got $25K per year for 5 years, breaking even year 4, and then a slight tweak to the policy, adding a little bit more term insurance, so I can fund it for 10 years at $25K per year. And I could keep paying the premium after that if I wanted to. Really depends how short or how long I want to pump money into the policy. But it's meant to show different options where I can see more cash value upfront and long-term, and then also building awareness. You know, one of the things I appreciate the most when I'm working with someone on a product or service that I don't understand is when they ask questions for me that I didn't think to ask. Hey, here's something that a lot of people ask. Hey, if you're looking to have a low minimum premium and you want to pump money into the product for a long period of time, I might look at this particular product with Mass Mutual, for example. If you want a lot of flexibility where you can commit to the minimum, pay just that, and then add money at your discretion, just like throwing money into the policy like you would with another account, for example, well, Guardian works really well in that case, and they're also one of the 4 major mutual companies. Awareness, and then looking at the examples. Like, that's one of my favorite things to do, but I also appreciate it when people do that for me. Anyway, let's wrap this up, because I'm rambling a bit. I have a lot of fun with this. The conclusion to the argument we heard around proof that a 4060 produces more cash value than a 1090 design. Does it really? No, I have not seen that happen. I have yet to see an actual case where a 4060 gives more cash value than a 1090. If someone wants to pay into a policy for a long time, as much money for as long as possible, you can do that with any type of design. You may have to expand what different companies and products you look at, but it's easy to do. Well, I should say it takes time to do, but it is possible to do. Like, you just have to be aware and take the time to see what's available. What we've always seen in terms of proof, and we've got case studies and real policies that date back as far as 1975, minimum premium policies have produced the most cash value. 1090s didn't exist back in 1975, not that I'm aware of, at least. But we've got policies dating as far back as 1975 where we track the actual cash value performance. And what I've seen is the minimum premium policies produce the most cash value when we look at actual results, and then also the guaranteed values. And that tells it all, in my opinion. Like, whatever is guaranteeing the most, I typically see produce the most on the non-guaranteed side as well. And if you said, hey, all of that's technical, what do I do? Follow the money. What corporations do, they want high cash value policies. They take the maximum cash value up front, which also results in them having the maximum cash value long term. So if corporations do it one way with that minimum premium design, why would we set it up any differently as an individual? Doesn't make sense. Not to me. So I do hope that this was helpful. I thoroughly enjoy talking about this stuff. Let us know your thoughts, and if you have any questions at all, please feel free to leave a comment below or reach out with any questions. And as always, I hope this helps. Thanks so much.